So, welcome to the Tax Talk podcast and an exciting mini series with Justin Lamb. Justin is a chartered professional accountant, chartered business valuator, and a founding partner with Jones Lamb LLP. Since 2014, Justin has been working in the field of financial litigation support and business valuation. In early 2022, Justin and his business partner, Mark Jones, started Jones Lamb LLP in Edmonton, Alberta. Jones Lamb LLP was founded with the vision of creating value through innovation. They strive to provide value by blending subject matter expertise with their data science and toolkits, creativity, and by striving to make the most complex things appear to be simple. Justin, thank you very much for taking some time out of your schedule to hop on the podcast today.
Hey, thank you, Jared. No, I appreciate the introduction.
For sure. I am looking forward to a couple of good episodes here on, I think, a topic that impacts a lot of small business owners, and I know it's cropped up with a number of my clients recently. So looking forward to get some of this information out there and hearing what you have to provide on this area of expertise that you work in. So getting into it, the first question that we wanted to look at are, what are some of the situations where a business valuation might be needed?
So, no, it is a good question. Like you said, it's especially now as more business owners are getting older, you see a larger interest in business valuation. And that just brings the primary and the most common reason that you see people needing a business valuation, that's buying or selling a business. Yeah, it's just a business valuation done by a chartered professional business valuator. Just provides you that foundation. It gives you that baseline number upon which you can, help provide some guidance on price, and also if somebody's looking to buy a business, what they should be paying for it. That's the most common, but there's a lot of others. We see them less often, but for some business owners just looking to plan for the future. I'm sure you've seen it where it tends to be the case that a business owner is looking for a business valuation when they're looking to sell now. So they made the decision. They've just told you, hey, I want to sell the business this year. It's just that time to transition or move on, pass on to the next generation. But unfortunately, that often leaves little time for proper planning. And so if you get it a few years ahead of time, if you're thinking of retiring within the next 3 or 5 years, having that valuation, A, lets you focus on ways to increase value, and B, position your business in a better place for a successful transaction. Yeah, I would say, and in addition to that, we often see them for tax purposes. So obviously, tax reorgs, or with that, doing different tax transactions to move it to the next generation. Those are quite common reasons. And then unfortunately, we do see quite a few for litigation. So, when you're multiple arm's length shareholders and things aren't going the way one party thinks they should go, unfortunately, that can breed conflict. And then, you get lawyers involved. And for those purposes, business valuation is required to buy somebody out.
No, that's a good point. Yeah, I would probably typically say from my point of view, it's that business owner that's, like you say, either right at that point that he's ready to go ahead and sell, or maybe, I've dealt with some clients here recently that, they're looking to transition, getting that value on the business, slowly bringing in, say some employees into the mix. So getting a bit of a baseline there. And, I find it's a good way to, establish that initial talking point. I think at the end of the day, the business is probably valued what, both parties are willing to pay for it in that free market where everybody's got equal information. But that valuation, at least it gives them a starting point to kind of work off, start those discussions, and, at least have a bit of financial background to fall back on when we're starting up those conversations.
No, and that's exactly it. It's, I'm sure you've seen cases, and I've seen cases where, discussions in terms of price have started with no foundation of value. It's more just, the business owner who understands their business very well and might have a pretty accurate idea of what it's worth. But they just tell, a potential interested party, hey, my business is worth X. And when they ask why, it's, well, that's just what I think it's worth. And that's never really a great place to start discussions or negotiations. It just, it lacks transparency, obviously. So, if you have that business valuation, and we always like to say, a business valuation is based on notional value. So it's, the standard of value in a perfect world is, both parties have a reasonable understanding of the facts. There's no pressure to sell, and both parties are willing to transact. But in reality, we know that's not the case, and that's kind of where you run into differences between price and fair market value. So we always tell people, hey, this is our value conclusion. It's the notional value. It's a theoretical value based on an analysis. But that doesn't mean that's what the price is. The price, will be based on a set of negotiations. Maybe the seller has health issues. They need to sell, or maybe they're going through, we often see, a matrimonial division. And so they need to liquidate for that reason. And all these things can influence price positively or negatively. And so we always, like to at least clarify that difference between notional value and price. It's just like you said, it provides the foundation, gives you a baseline to work off. And if you have it ahead of time, it also helps if you ever do, which has happened, where the business is looking at selling and they get an unsolicited offer. If you've already put that effort in to have that business valuation done, you at least can assess that offer, right off the bat. Hey, is this reasonable? Well, it's quite a bit higher than our business valuation. Maybe we should seriously consider it. Or it's lower. I don't know if it's, worthwhile pursuing.
No, and that's a good point, because I think more often than not, those things kind of creep up where you get these unsolicited offers. And I think if you're kind of working well in advance to have that valuation in place, you've probably then taken the steps on the tax side to ensure that the company's purified for, capital gains exemption, those types of things. So if that offer does come in and it is, to your liking and within that ballpark, then you're just kind of ready to go to move ahead with that, as opposed to, scrambling around trying to figure out, well, it is a good offer, but we're offside on a bunch of tax items here now. So yeah, I think that's a good point for sure.
No, and that is actually, you do bring up a really, really important aspect, which is just ensuring that company's purified. Especially, it tends to be the case where if this business has been around for 20, 30 years, there is a pool of cash that's accumulated. And, it's great from the owner's perspective. There's that deferral of keeping that cash in the business. But as we know, that can put them offside of using that lifetime capital gains exemption. And that can take a couple of years to purify the business. So, making sure you give yourself enough leeway can make a big difference in, one, a successful transaction, and two, just optimizing those after-tax proceeds.
For sure. Nope, great point. I think that sums up number one pretty good. Going into the second question, what are some of the methods used to determine a value? Can you kind of maybe just provide us with some high-end, analysis as to what business owners might be looking at there?
No, yeah, that's I'll do a very high-level overview, because obviously those are you could spend hours on each one of those topics. Definitely. But there's typically three methods that we look at. There's the income approach, the market approach, and an asset approach, and they're somewhat self-explanatory. So the most common of which is the income approach, and within that category, I'll say we typically use what's called the capitalized cash flow approach, and basically what you're doing is you're looking at historical cash flow generated by the company. You're normalizing for one-off items and items that aren't at fair market value. So the most common is wages paid to non-arm's length parties. Typically the owner is paying themselves an amount that's higher or lower than what you'd hire somebody else to do that same job. Or they might have children involved in the company, or a spouse who's not, who might be, again, similarly doing more or less work than what you'd pay an arm's length individual for that role. So you're making those adjustments to arrive at what the company should generate, what you hope prospective cash flow is going to be. And then from there, you apply your weighted average cost of capital, your multiple, to arrive at enterprise value or the value of the company, both equity and debt.
Gotcha.
And so that's the most common approach. Within that income approach, you also see what's called a DCF or discounted cash flow. And that is, it's less common mainly because you need a reliable forecast to do a DCF. And many businesses don't do too much forecasting, or it's just in a very, it's not that robust. Or if they're if they have a long history, there's not much growth, not much change is expected over the next several years, you're typically not going to need a DCF. A DCF is good for maybe newer companies or companies that might experience some significant growth over the next 3-4 years and then level off. And so then you're kind of looking at what they're expected to do over that, 4 or 5 year time frame, and discounting that to today's cash flow. Yeah, and then the next one is the market approach, and that's again similar like it sounds. You're looking at actual transactions. So as a business valuator, we subscribe to a database of business transactions and that have occurred, within most industries and within North America, that you can utilize to help assess. Typically we use it as a secondary method to assess kind of the reasonability of our conclusions. But it just helps you, again, actual transactions are the best representation of fair market value. So you definitely want to make sure you're looking at, what has gone on in that industry, and to ensure that any conclusion you reach using a cash flow approach is reasonable.
Right.
And yeah, just to jump in to the last one, which is an asset approach, and that's again like it sounds. You're valuing the company based on the assets it owns. So typically you're going to have adjustments to either bump up certain assets. Maybe they own real estate that might be worth more than what it's carried on at the books, and so you'll have an increase to that, as well as anything that's worth less to arrive at kind of the value of those assets. And then, if it's a going concern, if that business is expected to carry on in the future, the analysis stops there. If it's not, then you're looking at more of a liquidation value, and then you're going to start applying transaction costs to liquidate those assets, as well as both personal and corporate tax costs that would result on their liquidation.
Gotcha.
And
well, yeah, go ahead.
No, that kind of gives you a very brief overview of the main approaches. Like I said, you could spend hours on each one of those individually, but to keep it more concise, we'll stick with that for this one.
Sure. No, that's good. I think, from my limited knowledge in this field, those are definitely the three that kind of crop up when we're kind of talking valuation with clients. So when you're presenting maybe that, price to that client, do you kind of use a combination of the three to, set a range of values, or how do you kind of present that information to a client? Or is it just kind of, this is one hard dollar value, and then just kind of let the client work from there?
No, we try to, one of the things that we try in our reports is to make them as easily understood as possible. And we do that by, one, using a lot of graphs and depictions of value, how we can, because we find, and it's definitely maybe somewhat of a problem in our industry, is most valuations are just 20, 30 pages of Word and another 10 pages of Excel, schedules appended, and it's just a little too convoluted. People don't get as much out of it, or there's too much there, and so they just look for that number, the value conclusion, and then they don't go any further than that. And so we find if we can make it as easy to understand as possible, then there's a higher chance that the expert or the advisor and the business owner are going to read that report in detail and just take more out of it than searching for that bottom line number. So I guess back to your question. So we do use, like I said, income approach is the most common.
Right.
And so we'll start with that. And then we typically also utilize a market approach as a secondary method. And that's just, like I mentioned, to ensure that we're within the realm of what actually happens with that industry. It's great to, apply the theoretical aspects of business valuation and look at cash flow. But at the end of the day, if you're ignoring what's actually happening within an industry, then your valuation could be overstated, understated in a material way, and that's not helpful to any client either. If your business valuation is providing, I guess, unreasonable expectations. So we try and use both approaches, and that just helps us, again, ensure that our conclusions are reasonable.
Sure. No, that makes sense. So is there like a threshold for those market-based ones to be able to rely on those? Like, I obviously deal with a lot of smaller businesses, I guess. Would those, have comparatives on there, or can you kind of use some of the information on there and translate it down to maybe a smaller business?
So no, that is a really good question, and that can be an issue, especially within that market approach. Sometimes you're looking at public companies. Well,
Right.
a public company, a small business, those are two very different
Sure.
companies, and you can't really compare, a public company worth 100 million, that'd be on the low end, to a small business that's doing, 500,000 in revenue.
For sure.
But in terms of the transactional database information that we have available using, we use what's called deal stats.
Okay.
It does have a lot of transactions of small businesses. So you can filter, if it's a small business with, say, $1 million in revenue, we're going to, filter by businesses with $1 million in revenue. So we are looking at businesses that are as comparable as possible. And sometimes if the company is very niche, it won't have many comparables, and that's just a situation. But often there are at least, half a dozen or a dozen companies that have transacted in the past 5 years that are, somewhat representative of what you're looking at, or as close as reasonable to provide a gauge. So it's surprising that there is a lot of data for that smaller business.
That's probably a good point, I guess, from the business owner's perspective. If you're able to pull up some data that, shows favorably to them, that probably helps them in that negotiation stage to say, well, look, this sold within the last, 6-8 months or whatever. It sold for, even if it ties into their earnings multiplier or something to that effect, that probably gives them a little bit more legs in that negotiating phase. So that's good knowledge to know for sure.
No, exactly. And that's what we try and do is we always try and graph, here's our value conclusion, here's where your business is, and then here's all the other companies that we've seen in that industry and what they've transacted at. So you can kind of see where you land, and you can see the high and the lows and kind of the average. It's just to give you a good gauge of what to expect, because as we've all seen, small businesses unfortunately can be very the market to find a buyer can be quite small, and that's just the nature of what a small business is. And a lot of people are surprised that it can be a lot more challenging to sell a small business than you might think.
Right. No, good point. So I think that ties up number 2 pretty good. So moving on to number 3, in what circumstances would a business owner seek out a chartered business valuator instead of just going to, say, their accountant for some sort of valuation services?
No, that's a really good question. And the way I always like to think of it is the accountant, I like to think of them similarly as like a family doctor. So they have a strong understanding of accounting, a strong understanding, they can identify issues really well, and they understand the company very well. In many situations, that client's been a client for often can be decades. They know the shareholders, they know their goals, they've seen the challenges that business has faced, and they've seen the successes it's faced. And so they're a really great advisor in terms of understanding the company. But like everything, business valuation is not their specialty, and sometimes it just makes sense to refer to a specialist. And that's kind of what we always say is, this is what we do every day. We're obviously trying to stay up to date in terms of changing trends in business valuation, as well as I mentioned, what's going on in terms of transactions we're seeing in the marketplace. And so it just, accounting, as you know, is always changing. It's almost impossible for one person to know, the assurance rules, plus the tax rules, and plus kind of these additional advisory roles such as business valuation. And so to have kind of a team of specialists can just add additional value and just provide that client with a lot more just information and obviously efficiency too.
Right. No, that's a good point. So would there be, and I guess this may be a bit of a vague question, but is there maybe a revenue threshold or an asset threshold that, a client would kind of need to have in place before I maybe sent them to you? Because I know a lot of times we'll need to do, say, a valuation just to do a quick share exchange. Maybe the company was initially set up with the husband as the sole owner. Now we want to get the wife in there. Maybe it's only been in business for a year. It's just getting started out. There's not a whole lot there. We're basically saying, a couple of assets. There's not really any goodwill at this juncture. And we just kind of put a quick value on it to get this letter done and send it off to the lawyer. Is that something that you'd work with, or is it something that you want to say, I need to see at least X amount of dollars on, gross revenues a year or asset dollars to say that this is maybe worth your time and worth the client's time to kind of reach out to you?
Well, that's a good question. And what we typically say, I don't think there's a threshold. Obviously, if it's a very small business, it might not make sense from a financial point of view. But we do try. So, I mean, I guess a bit of a marketing towards Jones Lamb. So we try and be very transparent with our fees, and it's often an issue we find in business valuation or with business valuators. And so, to help with those situations in the small businesses and to provide them with certainty, we do fixed fee billing. So at the start, we, based on discussions with, the advisor and looking at the financials, we provide that client with a fixed fee, and that's the total cost. So at least they know right from the start, if they want to proceed with the valuation, it's going to cost, we typically say, basic small business, like you said, situation you mentioned, one shareholder, two shareholders, start around $4,000. And that covers a pretty large spectrum.
Right.
And so at least we try and provide certainty there. And then from there, if it doesn't make sense from that financial point of view, that would be based on the client's kind of own determination. But often we find, it's like anything, having that independent business valuation can still add a lot of benefit. One, from the perspective of just additional assurance that that transaction is at fair market value. And two, just providing additional details to that business owner in terms of, value drivers, risk assessments of their company, maybe benchmarking to within their industry, how does their current ratio, how does their debt to equity ratio compare to their peers, as well as additional analysis, whether that's with regards to, any forecasts that they have in terms of, items to consider that might help drive value or future value. So, obviously we mentioned it a bit, but, we always find a business valuation is also just useful for, like you said, those reasons that you mentioned when you're doing, a tax transaction, but also just as an added benefit. Yes, you're getting the final number, but you're getting additional information that may help improve operations and increase value, because ultimately most business owners want to grow their business. And if you can provide some guidance on areas they should focus on, it's just gonna, ideally help them achieve that goal.
Right. No, that's a good point. I think when you're looking at, and I guess it probably applies to a lot of professionals, but specifically in your case, when you're hiring on that valuator, you're probably looking at that end number. What's the business worth? So I can, get out there and negotiate, or whatever the case is, whatever you need that value for. But I think, like you mentioned, there's a number of different things that you bring to the table beyond just here's that ending dollar value. Maybe you're in the process of starting to plan for some succession planning. You're just kind of getting down that road. Well, you might be wanting to pass it on to the kids or something like that. You don't necessarily need to be driving up the value just to squeeze that out of them, but you might be wanting to drive that value up so you can see, that financial legacy keeps getting built through, the next generation. So having that valuator in place to be able to say, well, here's what's really driving the value of the business. If you guys focused here, here, and here, maybe you'd be, able to drive that business value down the road and just kind of keep growing things. So I think that's a good point there for sure.
No, no, and and you actually bring something else up when you mentioned transition to the next generation, as an additional kind of, uh, I guess maybe benefit or just useful aspect of a independent business valuation is often there's multiple children. Often one or more children is not involved in the business, and and if you do any transaction involving your kids or succession planning, you want to make sure at the end of the day the family's going to always get together for Thanksgiving dinner or Christmas. And unfortunately, we see it all too often where these transactions are not as transparent as maybe what one child thinks they could be, and that drives, well, it drives litigation, it drives conflict. And if at the start, if they've just done a business valuation that's independent, separate from the accountant, because unfortunately, sometimes there can be feelings where that accountant's biased to the,
Sure.
one individual who's involved in the business versus, the non business owning child. And if you have a bit more transparency, it could just prevent a lot of issues. And it's an unfortunate thing that you see, but you do see it a lot with small businesses that are being passed down to the children.
Right. And that's a good point. I like to kind of bring that up with my clients. At the end of the day, maybe you max out that value, but if in doing so, you fracture that family dynamic, and like you say, we're not doing Thanksgiving or Christmas anymore, have we really achieved, good succession planning? In my take, I would say no. At the end of the day, yeah, you want to find some tax efficiencies. You want to maximize that value as best as possible. But to me, it's always keeping that family dynamic in place, for generations to come. Because if that's ruined, then I don't think the succession plan was worth it in the beginning. So I think that's a good point. And I would agree with you. I mean, I know we have a lot of probably second or third generation, say for instance, farming clients now. And, they've probably been with one partner in the firm here for a significant amount of time. So, there probably is a bit of that, not necessarily an outright bias, but you could see a bit of a perceived bias there that, okay, mom and dad have been working with this accountant for 20 or 30 years now. Maybe they have, mom and dad's best interest in heart, not necessarily mine or my siblings. So to bring in that third party, especially when you're dealing with some of these bigger dollar values, out in the farm and stuff, with land prices increasing as they have, it's probably good to have that, third set of eyes in there, that unbiased opinion to say, at the end of the day, this is what it's looking to be, and you guys can kind of base it off of there. And at least you've got maybe that bit of a unbiased take on things to get the negotiations going. So good point there for sure.
Oh, no, exactly.
Perfect. So I think into number 4, how long does it typically take for a business valuation to be completed by, yourself or your firm?
No, and that's always an important question. And we always tell clients, and we definitely do our best to achieve this, is our typical turnaround time is 3 to 4 weeks from receipt of requested information. And we do our best to hold ourselves to that timeline, because all too often, it's just, again, it's unfortunate. It's a good aspect of being busy, but all too often we hate it when the client phones us asking for an update. If they have to phone us asking for an update, that means we failed along the way and that we haven't kept them up to date, or we haven't done things in a timely manner where where now they feel the need to start making calls. So we really try our best to do 3 to 4 weeks, and for the most part, we can achieve that. Like anything, the biggest holdup is whether we receive the information that we need. And often with our initial request, that covers 80%, and then once we start digging into the business, there's going to be additional questions that we like to either discuss with their advisor or the shareholder, and then from there issue our draft report in that time frame.
Correct. So I know you mentioned, and this kind of applies to me, everything hinges on getting that information in.
Yes.
Can't get the work done unless you have the information there to get the work done. So do you kind of have a standard, this is what we need to begin with, list of financial statements, tax returns, that type of thing? Or is it kind of a case by case thing that you set an initial meeting and just feel things out to see, how many shareholders there are, what the use of the report would be, that type of thing?
So yeah, typically, well, it depends on what we have in terms of information right from the start. But as far as standard information, is like you mentioned, the last 5 years of financial statements, most recent corporate tax return, details of any fair market value differences on any assets. Are there assets that are worth more or less than what they're carried on the books for? Those would be the big three items. And then in addition, details of any non-arm's length transactions. So, items that the shareholders pay themselves or purchase that aren't at fair market value terms. So that could be wages, or it could just be, discretionary expenses they run through the company. As we all know, there's a certain element of expenses that might not be required, but you're able to still deduct. And so we always ask for those details as well. And that kind of covers most bases. And then, like I said, once you start digging into the details and doing our analysis, there's going to always be additional questions, just to make sure that, one, we've taken the time to understand the business. I mean, it's we don't like doing a business valuation where you're not actually taking the time to talk to the owner or their advisor, and we just, you just are provided financial information and you spit out a business valuation, because again, that doesn't take into all the nuances that business owner has done building their company. I mean, often these businesses have been have been owned for 20 or 30 years, and this is that owner's life. And so you want to make sure that you've taken the time to understand their business, how it compares to their competitors, how it falls within the industry, and its strengths and weaknesses. And the best way you can do that is by having a discussion with the owner.
Sure. And that's a good point. Like you say, I think this process, and I guess it maybe depends on whereabouts the individual is that's looking for that valuation, but I think for the most part, it's a fairly emotional process. If you're getting to this stage where you're saying, I want to put a value on this, either to pass it down to one of my kids, get maybe a key employee involved, or maybe I just want to be ready should a third party come around. I think irregardless of the fact, like you say, if you've been involved with this for 20, 30 years, it's almost like another kid to you. You've put in a lot of time and effort to see this thing grow and get to the point where it is now. So I think, it is beyond just the numbers, and it's having that conversation and really working with the client to ensure that they feel, secure in what's going on. They understand the process, and you're not just treating it as cold, hard, black and white dollars and, here's the report, do what you want with it, because I think there is a lot that goes into the business, and I think there should be, a fair amount that goes into that valuation as well.
No, that's exactly it. And that is, I think, an area, like I mentioned, we always try to make sure we have those discussions. But in general, it is sometimes an issue within our industry that you could say just desktop valuations are being performed, where you just get the information in, you spit out the valuation, and you're not having those discussions. And the shareholder might not realize that those discussions should be had, and they might just take the valuation like, oh, I guess that's, hey, here's the value conclusion, this is what it's worth. But the overall process is a lot more valuable and useful, and it also helps in ensuring that our valuation conclusion is more reasonable, or is accurate as it can be, by having those discussions.
So what did it help, and I think you mentioned it before, and I could speak to this, is, the accountant does have a lot of, I think, very pertinent information as to, how the business runs, but maybe more so even to that, how the family operates, that you're never going to see in 5 years of financial statements and a corporate tax return. So is it easier then to kind of work this process, through the accountant, or at least have the accountant in some of these meetings to kind of say, this is what we're doing, this is what we're looking for, and then the accountant could kind of act as that kind of go-between between the valuator and then the business that is looking to sell?
Ideally, I think that would be the best situation, is to always involve the accountant, because it's exactly like you said. You know, they've seen that business through its ups and downs, but also the accountant. Lots of times the business owner is exceptional at operations. They're great at running the business. They're great at doing whatever that business does. But maybe financial. Again, we sometimes terminology can be a challenging thing, or just the lingo that we use. We try not to make utilize too much jargon, but it can be an issue. And sometimes people, if they don't understand, they unfortunately don't ask the question, what are you referring to? And so having that accountant will just ensure that, one, like you said, everything's as much as possible is considered, and that the client hasn't misinterpreted something that we've said or whatnot, because just again, it's not their specialty.
Perfect. No, that's really good. I like to kind of hear that you guys take that approach in being able to bring in the client and the accountant and kind of get the whole picture, because I think it's more than just numbers. It is a very emotional process, and capturing that entire discussion into getting that final value. I think that's really important, and it really helps that business owner get through that process, because it is a very emotional one for sure.
Oh, no, definitely. Like I said, you spend your life growing this business, and when you do sell it, so oftentimes price isn't the only factor. It's, you want to make sure that business is going to somebody that's going to continue on the legacy, maintain or keep existing staff on. You don't want to see, your staff that have been with you for X number of years out of a job, and that it's just going to be well managed going forward.
For sure. Definitely. So I think question 5 will kind of get us into a bit of a hotter topic. What can I do to avoid seeing CRA involved with the valuation of my business? So I know this kind of crops up with any of the limited work that we've done on it before. These price adjustment clauses, what do they do? Is there anything else that business owners should be kind of watching out for as far as moving property to the next generation, fair market values, those types of things?
Yeah, so this is a good question, and it I guess it builds on kind of your previous question. When does it make sense to use a business valuator? Obviously we're a bit biased, but we would say anytime there's a tax transaction, where you're repping on fair market value, or where there's a representation of fair market value, it's, I think, in the client's best interest to utilize a business valuator. And that's simply because, as you probably know, CRA has concluded many times that, price adjustment, you can't just put a price adjustment clause and hide behind it.
Right.
And have a client, how did the client come up with this amount? Well, it's their representation. It's based on their understanding. Okay, well, is there an analysis? Well, no, this is what the client feels it's worth. And now you have an issue on your hands, because CRA, contrary to what a lot of people believe, they do employ chartered business valuators. They have a very strong team of valuators for this specific reason, to find situations where transactions, especially involving non-arm's length transactions that have the capital gains exemption, are not at fair market value, and maybe people are just trying to reach a value to maximize the value of that tax transaction. So, and CRA's concluded many times, hey, they'll honor the price adjustment clause as long as there's been a bona fide intention of the parties to determine value. And one of the easiest ways to meet that hurdle is to use a independent business valuator, because that way, at least if CRA is asking, hey, how did you come up with this number? You just forward them the valuation report. They see it done by an independent business valuator. They see, okay, there's been a good faith attempt to determine fair market value. Obviously, we'd like to think that it's an accurate representation of fair market value, and therefore, hey, they move on to the next file, because there's a lot easier low-hanging fruit for them to attack.
Right on. So, and I think we had talked about this previously, kind of off this episode, but is it my understanding that there was some new legislation that was kind of brought in or tweaked to, essentially require a independent valuation on some of those kind of non-arm's length transactions? Specifically, I think it was related to farm property. Does that sound right?
Yeah, I think it's that bill C-201
Right.
that the government recently kind of put in place, which just allows business owners, from my understanding, to transition and utilize their capital gains exemption. So they can transition to their kids and make use of that cap gains exemption, which is pretty, pretty valuable piece of legislation. And so, we're starting to see more business valuations in that regard.
Okay.
And CRA in that, they haven't said you need to use a business valuator, but they said having a business valuator meets their criteria.
Okay.
So it's just, again, it just prevents issues. At the end of the day, the less problems the business owner has, the more they can focus on the business. No one likes having headaches with CRA, as we all know. There's a lot of great CRA agents. There's a lot of CRA agents that, could use maybe a bit more training, and you don't know what you're going to be assigned. And having and the particular agent that's dealing with a file can cause a lot of headaches.
So that's probably a good point. Maybe you're not required at this juncture to do something like that, but if you're talking about multi-million-dollar farms, it probably makes sense to get that valuator in place, get them involved in that process, not only just to protect yourself should CRA want to have a look at where you're coming up with some of these dollars, but, again, to preserve that family dynamic and preserve that legacy going forward. Because, like we've mentioned before, you might have that one child that's involved in that farming operation. Maybe there's a second that isn't, they're busy running their own, operation somewhere else. But at the end of the day, you're probably trying to equalize that estate somehow. So setting that value via that independent valuator, that's probably a good way to kind of set that up. Maybe you bring in some life insurance or something to equalize the estate, or whatever the case might be. So that's probably a good thing to kind of keep in the back of your mind as that, farm operator, getting those proper people on team just to ensure that that transition moves smoothly is probably a good idea.
No, and I would totally agree. I mean, I come from a farming background, and so I'm always paying attention um, to farms, and it is probably the most common area that you see conflict amongst family
Right.
members. And so, um, you know, if you can have an independent, in the case of farms, a real estate appraisal done on the land, at least then it prevents that issue of one child saying, well, hey, that transaction was done, the land was undervalued, and so got a benefit I didn't get, and now everyone's mad. And you start seeing that more and more. Well, it's like anything. As more money's involved, as the value increases, more people are coming to the table or want their slice of the pie. And so it's ever more important to be transparent, because unfortunately you do see a lot of families it is quite sad, fall apart just because somebody thinks, the farming child is receiving a benefit the non-farming child doesn't get, or vice versa, in that, the non-farming child has an interest, they're not involved, but they want, an equal share, and maybe it doesn't quite make sense given the contributions, and it's a very complex, ever evolving situation, and it's unfortunate when it doesn't go right.
For sure. Yeah, and I think by working with that valuator and the accountant, like you say, just because it's equal on paper doesn't necessarily mean it's equal. I mean, that farming child has to continue that operation on to kind of see the eventual value of his part of the estate, whereas the non-farming child, maybe he's getting cash out of the deal. So, having some sort of mechanism into place to, account for some of that risk, the tax that's associated with that farming child, there's a lot more inherent to, hold that child back down the long run than just taking that pile of cash out at the end of the day. So I think having those kind of independent experts there to kind of assist you with that discussion is probably a good thing to help out for sure.
No, and that's exactly it. And there's also, I think we mentioned, at the start, it can be nice, or it's just good due diligence to maybe get a business valuation for your small business, 2, 3, 4, 5 years in advance of when you think you might retire. And that same situation can apply to farming in terms of farmers sitting down with their accountant, maybe getting a better understanding of one, value, but two, kind of any tax implications associated with their farming operation, and how that impacts kind of their succession planning and passing things along, just to ensure that one, everyone has a clear understanding before the inevitable happens and dad passes away or whatever it might be. So that, hey, those discussions were had early on, everybody agreed, and everybody was on the same page. And hopefully that means that, like we mentioned earlier, people continue having, happy Thanksgivings and Merry Christmases.
Right. Yeah, and I think that's a good point. When you say 3, 4, 5 years ahead of time, I think this planning process, it's never let's go sit down on a Friday afternoon at 1 o'clock. We're going to chat for 2 hours and we're going to get everything resolved. And whatever we figure out that day is going to just translate into the next 5, 10, 20 years. The succession plan is just that. It's this ongoing plan that, it might look one way today, and then within a couple of years, well, maybe someone gets married, or maybe some grandkids come into the picture, and it's always kind of evolving and changing. So, yeah, you get that business valuator in there to set that initial price, but then you've kind of got that groundwork laid out for when things change down the line. You're already set. You've got some of these pieces figured out, and then if something big comes up, then it's not this complete shock. You've already got some of the groundwork to build off of. So I think that's a good point as well.
No, that's exactly it, because it is ever evolving. We've seen many cases where you think, the one child is going to take over the business, but it turns out, as time comes closer, that's just not their goal, or they no longer want to be involved, and so that, then you need to change your plan, and it is an ever evolving dynamic. And so, but at least if you're consistently having these pieces of the puzzle in place, it's a lot easier to adjust on the fly than it is to, I guess we could say, start from scratch when you've never had those discussions.
Perfect. So I guess just in respect of your time, I want to get this wrapped up here fairly quickly. I guess overall, is there any general comments kind of on the administrative side of business valuations that you wanted to just put out there for clients that might help them in the kind of the decision-making process of how to proceed with that valuator?
Well, I think it's just, one, if you're, it's great to have a business valuation. We think it's good for planning. But talk to a few business valuators. We always say, and again, maybe we're biased because it's how we do things, but try and get them to be as upfront as possible at fees.
Okay.
Too often estimates are provided with the background that it's hours times rate, and this is what we think it's going to cost. And then it can often be, unfortunately, a multiple of that estimate for whatever reason. And so, we always say, professionals most professionals will do a fixed fee, and it just helps everyone be held accountable. And that's why we like it. And so we just always tell people to, you want to find somebody that's a good fit, but you also want to make sure that there's transparency with fees, because it sometimes, unfortunately, can be an issue.
Right. No, that's great. Really appreciate that. So, Justin, I just wanted to say thanks for taking time out of your busy schedule to hop onto the podcast with me. I know you provided a lot of great information for, business owners, farmers, anyone kind of looking to get into that realm where they might need that valuator. So if people want to reach out to you, what's the best way that they can touch base with you?
Hey, no, again, hey, thank you for having me on. It was a great discussion. And yeah, if you have any questions, feel free to email me. My email is just justin@joneslam.ca, or call me 780-554-4323. And or just look at our website. Feel free to send a question through our website at joneslam.ca. And yeah, we always make sure we return calls, and we speak with whoever is inquiring, and have that discussion. And we're happy just to answer questions too. So never be scared to pick up the phone.
Perfect. I will put all that information in the show notes. So if you want to reach out to Justin to chat anything valuation, feel free to do that. That is it for this episode for the Tax Talk podcast. I'm Jared Pallon. Thanks again for listening. Take care, and we will talk soon.